Good day, all. Ira Epstein of Linn Associates with your agriculture update for this Wednesday, the 31st of July, 2019. I'm sitting here thinking about the market. Stock market down, we saw the FOMC statement, but that's not what impacted the grains today or the meats. I think it's lack of any progress at all between China and the U.S. that you can really say is solid. The two sides met. I don't consider that solid. Had the two sides met for days, I might have. But they basically, in Shanghai, had a dinner and met for a half a day and everybody went home. That's not a sign of anything happening, nor was yesterday the tweets by the president right as the meeting's going on that China's not living up to its deal and maybe we won't do deals and all that. Can't negotiate under those circumstances. I'm not sure China wants to negotiate anyway, so what's the difference? But you're seeing it in soybeans, and now you've got a problem because even the fundamentals of soybeans are working against them. If China, the world's largest really buyer of soybeans, is losing so much pork, and we're hearing, and I keep hearing, that up to 50% of their sow herd is gone. That means they can't breed, that there's still different swine flu epidemics breaking out, and this thing is not yet under control. And we know it has spread to other parts of small parts of Europe, or at least it hasn't spread everywhere, but it's gone to Thailand and other places. So something to think about. When we look at soybeans on the weekly area chart, last week you could see the market was beginning its correction. You had been down to 883 and a quarter after being up as high as this 906 level. Now the question is, would the market extend? And I drew a line just showing you where the market's down to in blue. And you're now down to the 864 level underneath that 18-week moving average of closes on the weekly chart. So this upside burst that we had has run its course. That doesn't mean it can't resume. That's not what I'm saying. I'm saying past tense. It has run its course. Now we're in that other part of the year that I did my best this week to explain. When you get to the planting part, and that's one event, and the growing part another, then you get to what does the harvest look like, and finally the actual harvest. We're in the part where it's growing, and what do we think the acreage is, and what could yields be, but you're still way too soon to get a real handle on it. When I threw on the daily bar chart yesterday for you, I also showed you a line that I think is the downtrend line. Now I want to take off today's action because I told you to envision at this 890 level a straight line going across. And now what the market has done is broken under that. It's a breakout to the downside. And when you look at swing lines, the only thing that would stop that is getting back over, at least right now, that 909 level. So we have a market with lower highs, lower lows, that is broken out of that action. This market momentum is pointing down. When we add moving averages, you get to see the validity of this 909, because to get over that, you've got to get through important moving average numbers of the 100-day average of closes and the 18. Both look to me at this point formidable at this number now in a resistance zone. In support, I'm going to take off today's action. This is how we've looked. And we really, since back here the first week of July, hadn't been down to a Bollinger Band. We had gone from a Bollinger Band high to low. Then we played around this 18-day average for a long time. We have now done what? With today's action, we've broken out to the downside. That's not to say that the first challenge of a Bollinger Band isn't where pros take some money off the table. I will stick with what I teach. Yes, and I am not saying you have to collapse from here. You've hit a downside target in a market that is oversold. So I wouldn't be surprised somewhere along the line to see some attempt at support. That is not necessarily a bullish sign. The bears are waiting, I think, those caught in this market to still sell it. In the meal market on the daily bar chart, different momentum. You have an embedded reading. Embedded means you've converted an oversold or an overbought trend to locking it in. In this case, it's bearish, and it locked it in. And that means that when the market goes to a Bollinger Band, yeah, it can bounce from it the way that I said earlier, but more times than not, when it's embedded, it lays against it. And that laying, because it's on the downtrend, can continue on that market. You'd have to get back over 307.80 to negate what? The swing line, lower high, lower low, but to really negate the momentum you've got to at least flatten out, which you haven't done, the slow stochastics, and to turn it, you've got to get the red line over 20. No sign of that yet. On the way up in the soybean oil, you would hit the 100-day average in green in the upper Bollinger Band. And I'm aware you can get through those and it looks like it's going to run away often. But more times than not, and that's what you play on charts, these averages and that Bollinger Band combination are important, especially if you're overbought, which you were in this market. So you started back and forth action. This was yesterday. You got under the 2837 level, which broke the pattern of higher lows, higher highs. You never were embedded. Now, if you get under the 18-day average, which you did today on a close, you put into play the potential, doesn't mean it has to go there, of either getting back to that Bollinger Band or playing around that 18-day average. The important thing is you're out of the uptrend. In the corn market, I was questioning if yesterday for you, could we get to the lower Bollinger Band and under or to that 18-day average of, the 100-day average of closes in green. The 18 is above the market. I said that because if we looked at the momentum, both numbers were under 20 on a close yesterday, the day before they were, and the day before. It means you're embedded. Embedded means you've already converted the market from oversold to being locked into a bear trend, and until you lose it with the red line getting over 20, the bears have taken control. And what happened today is you went down to those numbers. Often, the first challenge of them within a short period leads to a bounce away from it. Let's see if that occurs or not. That is not bullish. It's just where bears might be taking money off the table. In the wheat market, we had an outside day up on Monday. One of my tenets of what I teach in my charting course is whenever you have an outside day up or an outside day down, if it's an outside day up, you should not take out the low of that day for the next two trading sessions. If you do, the odds are you're going to put into play going to the closest of, on the downside, the nearest major moving average, which I'll call the 100-day in this case, and it is below the market, but if there's none there, then it's the Bollinger Band. Does it have to work? Nothing works all the time. But it's one of the things I teach. And the market yesterday, this is what you did, and today you took out that low and you went right to that 100-day average and you basically stopped at it. So it accomplished what I want, but what else did it do? Now you have a downtrend at work until you take out yesterday's high. You could go to the lower Bollinger Band, and admittedly, you're oversold, nowhere near embedding. In the sugar market, the battleground has been now for what, 6 days, the 18-day average of closes. The bulls have control at this time because you have higher lows, you have higher highs, you're over the 18-day average, so the bias is up. Momentum is up as well. The market's reading is a 68. It's going to get overbought tomorrow if it advances higher. So it's something you think in the back of your mind. But does that mean if you get through 1230, you can't get up to these two numbers? It does not. The 100-day average to me is the important one because it's the one that's been holding the market back. On the other hand, if you're going to lose control as a bull, you're going to take out the 1193 area. Now, could that just turn the market bearish? No, because you then have a higher high and lower low. So the bulls are in control until 1192 is hit, but they've got to make this market go or they've got a problem. And that problem would be they either embed like they did here or you just get overbought and you run out of momentum. The coffee market has done what we talked about in some of the others. It came down recently, challenged the combination of the 100-day and the lower Bollinger Band. This was on Friday. You have the embedded reading, so until that's lost, I'm expecting that rallies are well met with selling, and so far that's very much been the case. So the bears are still in control. Lose that red line, get it over 20, I'll change my opinion on the market. In the cocoa, similar to the coffee, you got down, challenged the combination of the lower Bollinger Band, the 100-day average right here. That was Monday. You started playing around that, and you can see that's just what you've been doing. Here, you're just oversold, so you don't have that momentum that you have in the coffee market. There's nothing bullish on the chart, but being oversold could lead to more of a bounce at some point. In the cotton, similar to the sugar market, look at how many days you're fighting at this 18-day average. Dissimilar about it is the fact that you have a lower low, higher high. So this is a market looking for direction, and as it's doing so, the Bollinger Bands are shrinking into the market in this sideways action. I don't see a trend there. Cattle market, first challenge of the lower Bollinger Band. So on the first challenge, that's where I think the pros take some money off the table. Resistance back at the 18-day average, but not a trend. You have a higher high and lower low. In the feeder cattle, today's action is ugly. I know you're going to say, well, it's still held, Ira, the 18-day average of closes, but now here's what bothers me. This was an outside day up. Today you took out the low of an outside day up. Remember what I just said. That puts into play the possibility that the momentum has shifted on you, and you see that in the slow stochastic, and that puts into play the opportunity for the lower Bollinger Band, which catches these traders while the market's been going sideways. Last in the hog markets, another limit down day. This market has just gone into a state of collapse. Think of it this way. This is the lead up to the U.S.-Chinese trade talks. The market's looking for what President Trump had said. Our leaders are going there. The Chinese have promised to buy agriculture products. We saw this week that they did buy 600,000 metric tons of soybeans, but no pork. And all of a sudden, as these things unravel, boom, the market's let go again. So pork in big trouble. What bothers me is we're coming to the end of the summer. So the demand for that barbecue season, we're in August. These kids go back to school in September. You don't barbecue the way you used to in another 4 weeks. Just bringing the point up. I talk about this and a heck of a lot more in my morning subscriber video. What I do in that particular video is by 6 a.m. roughly, and that's Central Time, I'm recording. The recording lasts about 15 minutes or so. Then I edit the recording. By the time I render and post, it's probably 6:40, 6:45 in the morning. My clients will have it by 7 a.m., typically Central Daylight Time. The reason that's important is it's before the U.S. major government reports come out. Generally, it's before most of the trading really picks up in its volume. It's before the stock market certainly picks up. And meats haven't opened in terms of hogs and cattle. They'll open at 8:30. So you've got your hands on everything. I review 40 charts on futures, 5 ETFs. In it, I'm able to say, buy here, sell there, do this, do that. I charge for that. If you get me up at 5 in the morning to do this, that's what I'm doing. And it's a trial, if you want, at 26.5 cents a day for the first 30 days. It's not a month to month. It's every 30 days. You can stop at any time that you want. You don't have to go for another 30 days. If you decide to continue, you can even go from month to month or 30 days to 30 days, the right grammar, and go to a 1-year subscription for $156 rather than $175. That's all your call, but you're tied into nothing. If you'd like to see more about it, go to our website under Market Research or Education. You can also call my staff. They'll be happy to help you, or you can click right up here. It'll take you to our page, take it from there, and away you go. I'm Ira Epstein. You have a great day, and I'll see you tomorrow.